markets are pricing in an imminent end to the global rate hiking campaign from central banks, largely boosting sentiment lately, but there are signs of slower growth, and of course there's still those risks of financial instability. So how should investors potentially be positioned in this environment? To shed some light on the issue, Paul Ashworth from Cameron Harrison joins me now. Thank you so much, Paul, for coming in today, or joining us, I really should say. Just wanted to get your view on the financial stability risks, because there seems to be a new chapter unfolding here. There was the initial crisis, everyone panics. We all have, a bit of flashbacks and PTSD from the GFC. Policymakers step in, things get calmed. Bank results from the blue chips are pretty good. But last night, now we've got First Republic talking about the deposit flight occurring there. How are you seeing this situation? Is it continuing to be sort of a live risk, or have we moved on from that and now just sort of trying to think about the implications for economic activity?
Oh, I think we've moved on. I wouldn't say we have averted. Whether we've averted or whether we've diverted, I think probably we've diverted at this point in time. I think the trading and the results announcement from First Republic overnight show however that it's a very live issue, and bank deposit funding will continue to be a big issue for a long time to come. And the position of electronic mobility of cash, has to be on the agenda of banks around the world. Is that necessarily a bad thing? Not over the medium to long term, but of course over the short term, as we see last night, it's a real issue for that institution.
So do you see this as a broad systemic risk where we could see, sort of a cascading effect and panic broadly spread, or do you sort of sit in the camp that seems to be the kind of consensus view, I guess you could say, at the moment, where, all right, well, this isn't going to cause some kind of major stress in the system necessarily, but it will have an impact on credit growth, it will have an impact therefore on activity going forward in the US economy, and we have to position for that accordingly as investors. Where do you kind of sit on this?
I think it's the latter, Carl. I think it's still got a degree of being idiosyncratic, but in terms of larger trading banks that are focused, long-standing, banks of significant systemic importance. I think central banks have made it fairly clear on a coordinated basis what is it they will do. So I think that largely addresses the systemic risk. The issue is it's just another example of yet again central banks having to step in, create these extraordinary liquidity positions. And rather than it being a once in 10-year event, they're becoming once every 3, once every 4 years, and I think that does have some medium longer term implications in terms of how investors and depositors think about the process of where they place funds, and how it is that they deal with banks. And obviously, then the role of non-bank institutions as well on more specific term funding arrangements. So yes, I think there are some significant broader implications for what the banking function looks like over the medium to long run.
So what are the implications here for policy? Because I mean, maybe I'm inducing the wrong answer here, but it would seem that the results of some of the major Wall Street banks laid some fears about those risks to the broader system, and perhaps even allowed rates traders to shift the focus back to inflation and the expectations that the Fed won't have to be so on financial stability risks, and they can just sort of, again, try and stick and focus on their inflation mandate. Would you agree with that statement? And do you think as a result that means that the risk for higher interest rates from here is elevated?
So I think I think the situation is that particularly the Federal Reserve having to deal with a very large banking system, both from a federal and a state regulated perspective. I think they are thinking of it on an idiosyncratic basis. I think from a large scale perspective, I think they are reasonably comfortable with the broader US banking system. And I think that's probably a fair assessment, Carl. And as you said, it allows them to address, what it is their pressing issue, and that is inflation fighting. And from that perspective, obviously there's schools of thought here. From our perspective and from our analysis, they've got more work to do. The market, as to where they see future Fed and cash futures, as to where the Fed plot is. There's obviously a bit of disagreement between the market and the Fed in that regard, and I think I don't think that Fed plot will fully play out. But I think the market is underestimating that the Fed does have work to do, in terms of the strength of the US economy. And I think one of the things in terms of obviously there's a lot of discussion in terms of earnings. There's a lot of discussion in terms of recession and what that might look like in the US. But if we're to get into recession, that would see obviously real growth under 0%. But in nominal growth terms, that would be maybe taking nominal economic growth in the US from 7.5%, maybe down to 5.5%. 5 to 5.5%. For the corporate environment, if you've got an economy running, and corporates and earnings don't think in real terms or inflation adjusted terms, they're just dealing with growth. They're dealing with nominal numbers here. I think maybe there's a little bit too much pessimism, in terms of macro earnings figures, because I don't think nominal growth is going to be that bad. And ordinarily, you'd be pretty happy with 5% nominal GDP growth.
I'll say, especially before the pandemic, that would have been a surprise, really. But I just wanted to ask just about, I suppose, portfolio implications. There's a lot of talk about remaining fairly conservative, maybe reallocating a little bit more to fixed income, assuming that we're at the peak of the interest rate cycle. There's also this interesting element that if you look at sort of investor positioning, a lot of bearishness already seems to be sort of priced in, I suppose. How are you seeing this in terms of portfolio management, how you actually approach this sort of fairly interesting dynamic?
Yeah, good question. So we're not focused as to what's going to happen tomorrow night. Mm-hmm. I will say that. We're forward-looking as to how we want to be positioned over the course of the next 6 to 12 months. We see, broadly speaking, Carl, an environment where, yes, growth is going to reduce in nominal terms, and that'll obviously flow through. But so too will, we think, inflation expectations. Yes, there will be some reduction in earnings growth rates, but also with that comes a reduction in long-term bond rates. From a discount factor, if we look at the US, in 12 months' time, you may be looking at a 10-year bond rate that it's got a 2 handle on it. To us, that looks reasonably attractive, for that investor. In terms of the growth versus value paradigm, we do, however, think that inflation will be more difficult. It'll be more troublesome. We think that whole secular stagnation environment, which has supported declining long-term bond rates, and lower real cash rates. We think that period's finished. So that does make it problematic for growth companies, over the medium to long run, and makes it quite attractive for and you've heard me say this before, in terms of the smart industrial businesses, that are trading on average 16, 17, 18 times forward PEs. So against that environment of reasonable nominal economic growth, reduction in longer term bond rates, and some pretty efficient enterprises there, ordinarily you'd say that's a pretty good trifecta, and that's largely how we're viewing it over that time period.